Autodesk holds a dominant position in the markets in which it competes, and its stock is up more than 3,000% since it came public in the early 90s. But is this stock worth buying today? Let's run it through our investing frameworks to find out. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to StockCar.io for sponsoring today's video. All right, Brian, Autodesk might be a company that not a lot of our viewers are familiar with. So what does this company do?
Autodesk is now a software as a service company. I say now because it was just a software company before, and they're the company behind computer-aided design, or CAD software. It's the basic thing that you need to know if you want to work in engineering, construction, or architecture.
And Autodesk literally makes dozens of software products that are designed to help architects, engineers, construction professionals, or even media and entertainment professionals to do their job.
When we look at the company's sales, you can see where the important industries are, with architecture, engineering, and construction being the most important by far, followed by their standard core of AutoCAD, again, computer-aided design. But here's what's interesting. If we look at the growth, oftentimes we see the smallest sections growing the fastest. With Autodesk, that's not the case. And I actually think that's a good thing. The growth from architecture, engineering, and construction is the fastest and the most important, which is a really positive sign.
One thing that's worth noting about AutoCAD is that about 5 years ago, it transitioned from a perpetual licensing model to a software as a service model. As a result, its financial results during that period didn't look too great. However, the company is now fully a software as a service business, and its revenue has been growing rapidly since it made that transition. All right, Brian, let's take this company through the anti-fragile framework. What do you see for the company's mission statement?
Autodesk's mission is to empower innovators with design and make technology. Those should be hyphenated so we know what they mean, so that they can achieve the new possible. I don't love that. The new possible, design and make technology, using lingo in there. It's not simple. It is inspirational and it is optionable.
Not my favorite mission statement either, but they do have one. Time to check out this company's moat. Do you think Autodesk benefits from the network effect?
I do think that they have a network effect, and the company calls out one form of this network effect by the more customers and usage that they have, the more data they have, which strengthens their developer ecosystem. And I think that's fair, but it's also worth stating that this has become the standard industry product that engineers, architects need to use. If you're graduating from college and you want to go into this field, there are other products available, but it would be really silly for you to leave without knowing how to use this. So I think that there is a strong network effect that I give them full credit for.
That's good to know. I'm not as bullish on their network effect as you are. I do think it's there. I actually think it's pretty darn weak. However, I think we're both going to agree about this next one. Do you think Autodesk benefits from switching costs?
Absolutely. If you and all of your employees learn how to use a certain platform and you're using it for all of your businesses, why would you ever switch? The company doesn't give specific numbers to let us know what their dollar-based net retention rate is, but they say that it's in the range of 100 to 110%. Now, we might be used to seeing other companies post higher numbers than that, but we've got to remember this is a very mature business that's been around since the 80s, and those are solid numbers.
This is the kind of software that takes years to really master, and once you go through the time to do so, you're going to be loath to switch. So I think this is Autodesk's major competitive advantage. How about low cost advantage? Autodesk benefit from that?
No, I don't think that that's a major advantage.
Neither do I. How about any intangibles?
You have to give them credit for their brand. Even I'm not an engineer and I know what AutoCAD means, and they're the ones who invented it.
I think that is fair. How about counter positioning?
No, I think that there's a lot of competitors who are taking the same approach that Autodesk is.
In fact, you could argue that a few years ago, the company was susceptible to counter positioning itself, but now that it's made the software as a service transition, that's no longer a threat. Moving on to optionality. Does Autodesk have it?
I think so. And what I did to prove this was I went to go look at how many tools they have. And what you see on your screen here is just half of the products that I could fit on one page that Autodesk offers. So yes, I think they absolutely have optionality, even if much of that has come via acquisition.
That's an important point right there. Autodesk didn't create all of these software products in-house like many other big software companies. It has bought them, but in my mind, there's no doubt that this company has optionality built into it. Time to take a look at the financials. What do we see as of October 31st, 2021?
Well, we see an upside down balance sheet where the amount of cash that they have is $1.8 billion and the debt is $2.6 billion. That goes back to, again, their acquisitive nature. However, that shouldn't cause too much concern because in terms of free cash flow, they're bringing in 1.4 billion over the past year.
Like you said, not my favorite balance sheet, but that huge amount of cash flow, which is also growing very rapidly, does give me a whole lot of comfort. Are there any concentration risks to be aware of?
There's one to be aware of. There's a distributor, Tech Data, that accounts for 37% of the revenue outside of the United States. So it's not 37% of all revenue. That being said, it's a distributor, not an end user. So I'm not going to ding them too much for that.
I'm not going to ding them for that either, but it is good to be aware of that concentration. Moving on to Glassdoor. Does this company get good ratings?
They get great ratings. In fact, CEO Andrew Anagnost is one of the top CEOs on Glassdoor for this year. 2 thumbs up.
Wonderful Glassdoor reviews. Employees clearly like working at this business. Are the founders still involved?
No, this is a picture of John Walker. He was one of the co-founders along with Dan Drake. But as we've said, this company was founded in the 80s, so they are not with the company anymore.
That's not surprising given when this company was founded. However, I take a lot of solace in knowing that the current CEO has been with this business for more than 20 years. Time for skin of the game. What do we see for inside ownership?
Well, here's the thing. Given that he's been there as long as you've said, I am a little bit disappointed. Insiders combined own less than 1% of shares outstanding. That's not super surprising given how old this company is and the founders are no longer involved. However, if you add together all of the ownership that insiders have, that accounts to just $65 million as of this filming. That's not that much.
That's really not that much, and that's definitely a negative for this business is that inside ownership is not very high. Not entirely surprising given that the founders are no longer involved in the age of this business. Still disappointing. Before we show you our final scores, we want to give a shout out to our channel members. Thank you so much for joining the channel. It really means a lot to us. If you're interested in becoming a channel member, you get access to badges and emojis whenever you post comments, and you also get to vote in member-only polls for what stock we research next. If that interests you, click that join button. And while you're at it, how about you give this video a thumbs up? All right, Brian, let's take it from the top. What'd you give for mission statement?
I gave them 1 out of 2 points because it was not simple.
I think that's perfectly fair. How about for moat?
So for the moat, I gave them full credit for the network effect, full credit for switching costs, and 1 point for their brand value to bring it to 5. That's a very high moat score.
That is an extremely high moat score, and I think appropriate in this case. How about for optionality?
I gave them 2.5. Look, if they had created all those products in-house, I might be willing to nudge it up to a 3. For now, 2.5. If that media and entertainment business really takes off, I'd also be willing to up it to a 3.
I think that's completely fair. Moving on to financials. What'd you give it there?
So I gave it 0. They have an upside down balance sheet, but they also bring in tons of free cash flow. So I'm going to call it even.
Fair enough. Concentration risk?
I took a 0.5 point off, again, mostly just so I'm aware that distributor Tech Data is going to probably become more important as their international business grows.
All right. How about for Glassdoor?
Definite thumbs up. They have great reviews.
Founder?
No longer involved, not the company's fault, so they don't lose any points.
It is worth noting that the CEO here has been at the company for more than 20 years, so one thing to just keep in mind there. And for ownership?
This is where they lose a point. I was disappointed, even knowing that this company is as old as it is, that they have so little insider ownership.
All right, we add all that together and we get an 8. That is in your robust category, but at the lower end of the pool.
It is, and it's not that surprising because this is a software as a service company that's a lot older, so the founders aren't involved. They don't own as much. If those two things alone were changed, it would automatically shoot up to an 11.
All right, time to take it through my investing framework. Financially, I gave this company a 15 out of 17. Really liked what I saw there, except for the debt. For moat, I gave the company full credit. I think if you add in a light network effect, a light brand, and high switching costs, that gets you there. For potential, I only gave it a 13 out of 18. One reason why is this company is already so profitable. There's not a huge amount of room left for growth, but I still think there is operating leverage ahead of this business. Customer quality, I gave it a 7 out of 10. Customers are very expensive to acquire, but once they're on board, their spending is essentially recession-proof. For revenue quality, got a 10 out of 10 from me. The gross margin here is extremely high, and 100% of the revenue is recurring. For management and culture, I gave it a 9 out of 14. I wasn't in love with the mission statement or the inside ownership, but besides that, there was a lot to like. The stock is where this company really shined. Not only has the stock thumped the market moving backwards, but the company is using its capital to reward shareholders, and it has a history of blasting past Wall Street's estimates. For the gauntlet, I subtracted 0 points. You could make the argument that that's too generous and I should knock some points off for concentration, but I'm comfortable with giving him a 0. You combine all that together, and this company got an 84 on my investing checklist. I happen to think this is a very high quality business.
And on mine, it's still definitely within that investable range. It just got an 8, which is on the lower end. But as I said, founders involved, a mission statement that works, high insider ownership, that brings it to a 12.
I don't think we're going to see those changes anytime soon, but that would be great if they could. All right, Brian, time to hold ourselves accountable. Both of this is going to enter our thumbs up portfolio on stockcard.io. So I'm going to head on over to the anti-fragile portfolio, which is your thumbs up portfolio. I'm going to click create a new order. I'm going to type in the ticker symbol, which is ADSK. We're going to do a buy decision. Today's date is Monday, December 13th when we're recording this. This is a $269 stock, so we're going to buy 4 shares, and this got a score of 8 on your investing framework. Then we're going to head on over to my investing portfolio, and we're going to do the exact same thing.
And while Brian is doing that, we want to remind folks that you can see our portfolios and the performance for free on stockcard.io, but we also encourage you to become a member, and by doing so, keep track of your own portfolio. While we're not concerned about stock movements over the short term, over the long run, keeping track of yourself and keeping yourself accountable is a great way to learn.
Overall, I think that both of us are pretty impressed with AutoDesk the business, even if it didn't score as well on your checklist as it did on mine. This is a stock that I personally own and have no plans to sell for many, many years to come. Brian's out.